Let's take a look at this problem that's a cash budget, deals with an income statement and a balance sheet as well. So we're looking at the Quinton Company. They're a wholesale distributor of soft drinks. The company's balance sheet appears as you see, right in here. So we've got $466,000 total assets and liabilities and stockholders' equity. And then there's some other information we need to read down in this area here. The company is in the process of preparing budgeted data for May. A number of budget items have already been prepared as stated below. So note A says sales are budgeted at $300,000 for May. Of these sales, $120,000 will be for cash, and the remainder will be credit sales. 35% of a month's credit sales are collected in the month the sale is made, and then the remainder gets collected in the subsequent month. And all of the April 30th receivables will be collected in May. So we know that $75,000 there is going to be collected in May. Now, let me slide up and we'll read a little bit more here. There. B says purchases of inventory are expected to total $216,000 during May, and I'm reading this section right in here, right? These purchases will all be made on account. 60% of the purchases are paid for in the month of the purchase, and the remainder are paid in the following month. All of the April 30th accounts payable to suppliers will be paid during May. Then C says the May 31st inventory balance is budgeted as $50,000. Reading right here. Okay. D, selling and administrative expenses for May are budgeted at $71,000, exclusive of depreciation. Those expenses will be paid in cash, and depreciation is budgeted for $5,000 a month. The note payable on April 30th will be paid during May with $200 interest. All of the interest relates to May. New refrigerating equipment, this is note F, costing $10,000 will be purchased for cash during May. And G says during May, the company will borrow $70,000 from its bank by giving a note payable to the bank for that amount. The new note will be available in 1 year. All right, let's tackle requirement 1 first. And let me slide this up on the screen so we have that. Requirement 1 says, what's the expected cash collection for sales, from sales, and the expected cash payment for merchandise purchases during May? And we are to omit the $sign in the response. Okay, I've got it covered up, but let's tackle the collections on accounts receivable first. We've indicated above in our notes that all of the April 30th balance will be collected during May, right? So what we do is we start off with the cash sales first, and they told us that was $120,000. The April 30th accounts receivable balance is all going to be collected during May, so that's $75,000. That information was given up top in the balance sheet. And then we need to take May sales, which is $180,000 times 35%. Now let's go back and see where that $180,000 came from. Okay, they had 300 sales in total, of which 120,000 was cash sales. So 300 less the 120 gets us the 180. And let me slide back down. That's where that number comes from. So the 35 times 180,000 is 63,000. So the total cash collections is $258,000. Now we tackle the schedule of cash payments for purchases. We're going to pay off the April 30th accounts payable balance that was given in the problem. That was $89,000. And then they tell us that 60% of the payments are made in the current month, right? So purchase of inventory is expected to total $216 during May, and 60% are purchased in the current month. So 216 times 60% is $129,000, and that's the total amount that we're going to pay of cash payments. So in terms of requirement 1, we've answered the cash collections here, and we've determined the total cash payments here. Okay, now I've moved the screen a little bit, and you see near the bottom the requirement for Part B, which is compute the total cash available and the total cash disbursements for May before any financing transactions. I'm reading right here now. Compute the ending cash balance for the month of May, including any finance transactions. Okay, so let me slide up so we can take a look at how that works. And I think we can go to about here would be fine. Okay, the beginning cash balance is given in the problem, $11,000. Let me pause and I'll show you where that comes from. Okay, now I've slid back up top, and here's the information that we provided before. There's where the 11,000 comes from. Okay, now I've slid back down in the problem, and we'll go on. Add the collections from the customers. Well, we've already calculated that, right? I think we calculated 258,000. Let me put the solution up there and show you where there's the 258. I'm just dropping the solution right above so you can see it. And that 258 gets carried here. Less the disbursements, and they tell us in the problem that there'll be 218,600 of inventory. We calculated that right there. Sliding on down. Selling and administrative expenses, they told us that we would pay in cash is 71,000, and they told us there'd be a purchase of equipment for $10,000. So the total cash disbursements is $299,600. When we take the beginning, add the collections to come up with cash available, then subtract the total cash disbursements, we wind up with an excess or a deficiency of cash, in this case a deficiency of cash available over disbursements of $30,600. So we're going to borrow on the note, and we borrow $70,000. Then we repay the note, the $35,000, and we tack in interest of $200 for a total financing cost of $34,800, right? Or total net financing, if you will. Borrowings less the expenses less the interest, so the cash balance at the end is equal to $4,200. All right, now I just wanted to slide back up to explain where that $70,000 of borrowing came from. They tell us $70,000 will be borrowed at the end. They tell us the interest relating to May is $200. New refrigeration equipment is $10,000. So pretty much they're guiding us through how to solve Part B. And as I slide down here, you get a chance to see Part B again. Okay? So that takes care of Part B. Okay, and then the next part of this problem asks us to prepare a budgeted income statement for May and use the absorption costing income statement format. And here you see the solution in front of you using the absorption costing income statement format, which is, the typical approach, right? Not the cost volume profit or contribution margin approach, but the more typical financial reporting approach. So we start off with sales, and really all that's involved now is just plugging in the information we've already calculated elsewhere in the problem. So let me sort of bring this to light. We start off with sales, and we know it's $300,000. That's given in the problem. That we knew we had beginning inventory of $42,000, also given. I believe we calculated purchases, or it was totally provided in the problem, right? All of these information was provided earlier. Add those two together, we come up with cost of goods available. We're able, from the information, to determine the ending inventory. We subtract, and then of course once we take goods available less ending inventory, we're able to compute cost of goods sold. Subtract cost of goods sold from sales, and you get gross margin. Slide this down. They told us we were going to have total cost of selling and administrative expenses of $76,000. Keep in mind at this point depreciation is included in the income statement. It may not impact cash, but it is included in the income statement. When we subtract 76 from $92,000, we wind up with net operating income of $16,000. Subtract the $200 interest expense that was given earlier in the problem, and we wind up with net income of $15,800. Okay, I'll remove that, and that's this part of the problem. Okay, next we move into the last part of the problem. Requirement 3 says prepare a budgeted balance sheet as of May 31st. And here again, we're using our knowledge of what goes on a balance sheet. The assets go under assets, liabilities and stockholders' equity, and where it belongs on a financial statement. And we're using the information we've already either been provided or calculated. So we calculated the ending cash balance of $4,200. We're able to put that where it is. And I'm going to go down the assets first, even though I'm revealing the liabilities as well. And then I'll move over so we can focus on that. All right, we know from our sales how much will be collected. So if we know what our beginning accounts receivable balance was, then we knew what would be collected. Then we also are able to calculate what new sales would be made, and we subtract off which ones would have been paid during May and which ones have been made by cash. And when we walk through that logic, we're able to calculate what the ending accounts receivable balance would be. Right? Start off with the beginning, add in new sales made on account, back off any receipts of old accounts receivable made on account, and we're able to compute the ending accounts receivable balance. Inventory, we knew what the beginning inventory was. We knew what new purchases of inventory would be. We back off any cost of sales and essentially inventory going out the door, right? And we're able to then calculate ending inventory. We knew what beginning building and equipment was, net of depreciation. We knew how much depreciation was, so we subtract that out. Then we add in any new purchases and any new incremental depreciation. And I think they just gave us total depreciation on this one, so they simplified it for us. And we're able to come up with total assets. Add those up, we come up with total assets. All right, let me slide over to the right now. Okay, now I've slid over to the right, and I've already revealed the answers, so we'll just talk through them. Accounts payable, we knew what the old balance was. We know what we purchased on open account for the month of May, so that will increase the balance. And then we subtract off what we paid off of the old account. And when we do that, we're able to compute the ending accounts payable balance of $86,400. The notes payable, we take a look and we say, did we have any in beginning? And I believe in this problem we did not. And we took on a new note payable, so that needs to show up as an obligation. And we show that on the liabilities side of our balance sheet. So we've got $70,000 that appears. Capital stock was $280,000. We had no transactions this period that impacted capital stock. So therefore capital stock is the same at $280,000. And then retained earnings, we start off with beginning retained earnings. We add in any net income that we had, that we previously calculated, and we would subtract out any dividends if there were any. I believe in this problem no dividends were mentioned. So we're able to take beginning retained earnings, add in net income, and we're able to come up with a projected retained earning balance. In fact, all of these are projections. And if we did this right, our assets will equal our liabilities. And that takes care of this problem, everyone. Thank you.